Imagine waking up to a market where the price on your screen no longer matches reality, where the number quoted on financial television is only a suggestion, while the real price is hidden behind delays, rationing, and out-of-stock notices. This is not a theory. This is what is happening to silver. For decades, silver was treated as a secondary metal, too industrial to be pure money, too monetary to be just another commodity. Ignored during booms, mocked during crashes. But quietly, beneath the surface of global finance, silver was becoming something far more dangerous to the system than gold. Because silver is not just stored, silver is consumed. Every solar panel needs it. Every electric vehicle depends on it. Every missile guidance system, every satellite, every data center, every medical device, every advanced circuit running the modern world uses silver in some form. And once that silver is used, most of it is gone forever. Recycling recovers only a fraction. The rest is lost in landfills, in electronics, in industrial waste streams too expensive to process. Year after year, more silver disappears than is replaced. This has created a problem that can no longer be hidden. For over 5 consecutive years, global silver demand has exceeded global supply. Not by a little, by hundreds of millions of ounces. At first, the deficit was absorbed quietly. Vaults were drawn down, exchange inventories declined, strategic stockpiles were quietly reduced. ETFs bled metal while investors chased risk assets. The system survived because trust survived. As long as people believed that paper contracts represented real metal, everything worked. As long as most participants were willing to settle in cash instead of demanding delivery, the illusion held. But every system built on leverage has a breaking point. And in 2026, multiple pressure points hit at once. The most important came from China. China is not just another participant in the silver market. It is the refining hub, the choke point, the country that controls a dominant share of the world's refined silver supply. On January 1, 2026, China's new export licensing regime went into effect. Officially, it is not a ban. In practice, it functions like one. Exports now require government approval. Only a limited number of companies are authorized. Volumes are restricted, shipments are delayed, scrutinized, and rationed. Silver did not disappear overnight, but the flow slowed, and when a market already running a structural deficit loses even a small amount of supply, the consequences are exponential. This is how shortages really begin, not with empty mines, but with friction. Shipping delays become normal, wholesale availability tightens, dealers quietly raise premiums, then rationing begins. 25 coin limits, pre-orders with no guaranteed delivery dates. 3-week delays become 4 become 6. This is not panic, this is logistics breaking under pressure. At the same time, something else began to happen. The paper-silver market continued trading as if nothing had changed. Futures contracts changed hands by the billions of ounces. Prices fluctuated on screens. Algorithms responded to headlines. Margins were adjusted. Liquidity appeared intact. But physical buyers noticed something was wrong. The metal wasn't there. The price of paper silver and the price of physical silver began to separate, slowly at first, then violently. This phenomenon is not new. It has happened before in commodity markets under stress. But silver is different because of how extreme the leverage is. For every ounce of physical silver available for delivery, there are dozens, sometimes hundreds, of paper claims. As long as most participants never ask for metal, this works. But when confidence breaks, even slightly, the math stops working. Industrial buyers do not care about spot price. They care about supply certainty. A solar manufacturer cannot halt production because silver is too expensive. A defense contractor cannot delay delivery because a futures contract settled in cash. These buyers will pay almost any price to secure material. And when industrial demand becomes price insensitive, price discovery shifts away from futures markets. This is the beginning of a real squeeze. Not a speculative squeeze driven by retail traders, but a structural squeeze driven by necessity. At the same time, the global financial backdrop makes the situation even more dangerous. Governments are drowning in debt. Interest rates cannot rise high enough to fix the problem without collapsing everything else. Inflation is no longer an accident, it is a policy outcome. In such an environment, trust in fiat currencies erodes slowly, then suddenly. Investors search for assets that cannot be printed. Gold absorbs fear, silver absorbs reality. Because silver sits at the intersection of money and industry, it reacts faster, sharper, and more violently than gold. Historically, when silver moves, it does not move in steps, it moves in shocks. The supply side cannot respond quickly. Most silver is mined as a byproduct of copper, zinc, and lead production. Higher silver prices do not immediately create more silver. New mines take years, permits take longer, environmental restrictions tighten, capital is cautious. Demand, however, moves instantly. This imbalance is why silver markets have always been unstable under stress, and why they are approaching instability again. Local coin shops running out of inventory are not the cause of the crisis, they are the signal. Retail shortages appear last. By the time the public notices, the wholesale market is already strained. This is why, out of stock, signs matter more than price charts. They tell you what the screen cannot. They tell you that the system is being tested. And the question is no longer whether silver prices will rise. The question is whether the paper price will remain relevant at all. Because markets do not break in one day. They stretch, they distort, they disconnect. And then suddenly everyone realizes the same thing at once. The price was never the problem, availability was. What most people don't understand about silver is that its real battlefield is not the mine. It is the exchange. The COMEX, the LBMA, and other paper markets were never designed to deliver metal to everyone. They were designed to provide price exposure, hedging, and liquidity. Delivery was always the exception, not the rule. For decades, this worked because almost nobody asked for physical settlement. Contracts were rolled. Positions were netted, cash replaced metal. But leverage only works when confidence holds. Today, the leverage in silver is extreme. Depending on the reporting period, estimates suggest that for every 1 ounce of deliverable silver, there may be 50, 70, or even more paper claims. This means the system is stable only as long as less than a few % of participants demand delivery at the same time. That is not a large margin of safety. As inventories decline, that margin shrinks even further. Registered silver, metal actually available for delivery, has been trending lower for years. Eligible silver may exist in vaults, but it is not promised to anyone. It belongs to someone else, and ownership matters. When industrial users, sovereign buyers, or large funds decide they want metal in hand, the exchange cannot simply print it. At that moment, futures markets stop being price setters and start being price followers. This is how real price discovery returns. History gives us warnings. In the late 1970s, silver exploded upward as physical demand overwhelmed paper mechanisms. In 2011, silver surged again, driven by investment demand and declining confidence in monetary policy. But today's setup is more dangerous than both. Because back then, silver was mostly a monetary story. Today it is a supply chain survival story. The world is electrifying, energy grids are expanding, military spending is accelerating, data consumption is exploding. Silver demand is no longer optional. At the same time, globalization is reversing. Countries are prioritizing domestic supply. Export controls are becoming normal. China understands this better than anyone. By controlling refined silver exports, China gains leverage not just over prices, but over industries. Every delayed shipment forces buyers to scramble elsewhere. Every restriction tightens global competition for remaining supply. This pressure does not show up immediately on a price chart. It shows up in behavior. Dealers stop offering fixed delivery dates. Manufacturers increase inventory buffers. Governments quietly accumulate strategic metals. And investors who once trusted paper exposure begin asking uncomfortable questions. What happens if delivery fails? What happens if settlement is forced in cash? What happens if everyone rushes to the exit at once? Markets are built on trust. When trust erodes, velocity changes. Silver is especially sensitive to this because it is small. The entire global silver market is tiny compared to equities, bonds, or even gold. It does not take much capital to overwhelm it. It only takes conviction. This is why price targets like 100 or 150 sound extreme to people who only look at charts. But charts do not measure scarcity. They measure past trades. In a true supply squeeze, price becomes a rationing mechanism. It rises not because value increased, but because availability collapsed. And when price is used to ration essential industrial inputs, it overshoots violently. This is where volatility explodes, margin requirements rise, forced liquidations occur, weak hands are shaken out. But physical holders are not affected the same way. They are outside the leverage system. This creates a two-tier market. One price for contracts, another price for metal. The longer this disconnect persists, the more credibility paper markets lose. And once credibility is questioned, confidence can vanish overnight. That is how markets break. Not with a crash, but with a realization. A realization that the promise was never the asset was the metal. And when that realization spreads, it spreads fast. Because the question shifts from, what is silver worth? To, can I even get it? When shortages reach this stage, investors are no longer the most important buyers. Industry is. This is a critical distinction most market commentary ignores. Investors can wait. Factories cannot. A solar panel manufacturer missing silver deliveries does not lose paper profits, it loses contracts, market share, and government subsidies. A defense supplier missing silver inputs risks breaching national security obligations. A semiconductor producer missing one component can shut down an entire production line. For these buyers, price is secondary, certainty is everything. This is why, in a true supply squeeze, industrial users quietly move first. They do not announce purchases. They do not speculate. They simply pay whatever is required to secure supply. This is how physical premiums detach from spot prices. While paper markets debate resistance levels and technical indicators, real buyers are negotiating behind closed doors. Long-term contracts, direct refinery deals, prepayments, off-market transactions. None of this appears on a chart. And yet, this is where the real market forms. At the same time, exchanges face an impossible balancing act. They cannot admit shortages without triggering panic. But they cannot deliver metal that does not exist. Historically, exchanges respond to this pressure in predictable ways. They raise margin requirements. They change contract rules. They encourage cash settlement. They delay delivery windows. Each of these actions is presented as risk management. In reality, they are containment strategies. The goal is not to fix the shortage. The goal is to slow the reaction. But containment has limits. If a single large participant demands delivery and refuses cash, the system must choose between credibility and convenience. This is where forced settlements occur. Cash is offered instead of metal. Premiums are negotiated quietly. Non-disclosure agreements follow. From the outside, everything looks normal. But internally, the message spreads. Delivery is not guaranteed. Once that idea takes hold, behavior changes instantly. Funds reduce paper exposure. Hedgers seek physical alternatives. Retail investors stop trusting ETFs. This is how confidence drains from a market without a headline. Governments watch this closely. Silver is not just an investment asset. It is a strategic material. In times of stress, governments do not compete openly with the public. They secure supply silently. Strategic stockpiles are built through intermediaries. Purchases are disguised as industrial demand. Export restrictions appear temporary. By the time official statements are made, the metal is already spoken for. This creates a feedback loop. Less available silver leads to higher premiums. Higher premiums signal scarcity. Scarcity attracts more demand, and because supply cannot respond quickly, price accelerates. This is why silver moves are rarely smooth. They gap, they spike, they overshoot. Then they pause, not because the problem is solved, but because the system is recalibrating under stress. This is also why attempts to suppress silver prices historically fail. You can manage perception, you can manage liquidity, but you cannot manage physics. Metal that does not exist cannot be delivered. At some point, price must reflect that reality. And when it does, it often does so in a way that shocks even those who were bullish. The 100 level is not psychological. It is mathematical. At higher prices, demand begins to ration itself. Low priority uses disappear. Marginal buyers step away. But essential demand remains. This means prices must rise until only the most urgent buyers remain. That level is unknown until it is reached. What is known is this. Every year of deficit tightens the spring. Every restriction adds tension. Every delay increases fragility. And once the release happens, it is impossible to control. This is not a prediction, it is a pattern. Markets built on leverage always appear stable, until they are not. And when silver finally reprices to reflect its true role in the global system, it will not ask permission, it will simply move. When markets reach this phase, the final transformation is not driven by headlines. It is driven by behavior. People stop asking what silver might be worth in the future and start asking what it is worth right now, in their hands. Delivery timelines matter more than charts. Trust matters more than liquidity. This is when a market quietly redefines itself. A true silver revaluation does not look like a straight line upward. It looks like instability, sharp moves, sudden pauses, periods where prices appear disconnected from logic. This confuses most observers. They assume volatility means uncertainty. In reality, volatility means the old pricing mechanism is failing. When futures markets lose their authority, price discovery migrates. It moves to private contracts, to industrial supply agreements, to physical premiums negotiated quietly, far away from public exchanges. The quoted price becomes a reference, not a truth. This has happened before in other commodities. Oil experienced it during supply shocks. Natural gas experienced it during infrastructure bottlenecks. Rare earths experienced it when China first restricted exports. Each time, the same pattern emerged. At first, officials denied shortages. Then they blamed speculation. Then they adjusted rules. Finally, prices reset at a level nobody thought possible months earlier. Silver follows this pattern with one crucial difference. Its market is small, much smaller than most people realize. It would take only a fraction of global capital flows to overwhelm available supply. And once metal is removed from circulation, it does not come back easily. This is why late-stage silver markets become extremely asymmetric. Downside becomes limited by scarcity. Upside becomes unpredictable. At this point, narratives change. What was once called hoarding becomes strategic stockpiling. What was once called speculation becomes risk management. What was once dismissed as conspiracy becomes common sense. This is not because reality changed overnight. It is because the cost of denial finally became too high. Governments face difficult choices here. Allow prices to rise and risk political backlash, or intervene and risk empty shelves. History shows that intervention rarely creates supply. It only changes who gets access. Export controls expand, subsidies increase, industrial priorities are established, retail buyers are last in line. This is why availability matters more than price in the final phase of a squeeze. Once silver becomes classified, even informally, as a strategic material, free market access shrinks. And when access shrinks, price becomes secondary. At that point, 100 silver no longer sounds extreme, it sounds insufficient. Because price is no longer signaling value, it is signaling urgency. This is when people look back and realize the warning signs were everywhere. The premiums, the delays, the rationing, the quiet policy changes, the inventory drawdowns. None of these were accidents, they were symptoms. The silver market does not collapse in a dramatic explosion. It tightens until it can no longer breathe, and then it resets, not to punish participants, but to reflect reality. A reality where silver is no longer abundant, no longer cheap, and no longer taken for granted. This is why 2026 matters. Not because it marks a top, but because it marks a transition. From paper dominance to physical relevance, from speculative narratives to strategic necessity, from convenience pricing to scarcity pricing. In every major commodity revaluation in history, the same truth emerges. Those who waited for confirmation paid the highest price. Those who ignored noise and watched availability understood first. Because in the end, markets do not answer to opinions, they answer to supply. and supply, once gone, does not negotiate. By the time the public realizes what has happened, the transition is already complete. There is no announcement, no official declaration that the silver market has changed. There never is. Instead, people notice it in small, uncomfortable ways. A dealer who used to ship in 2 days now says 6 weeks. A product that was always available is suddenly allocation only. A premium that once seemed outrageous becomes normal. And quietly, the question disappears. Not, why is silver so expensive? But, where can I still find it? This is the final phase of every supply-driven revaluation. Price stops being a signal and becomes a barrier designed to slow demand because supply cannot increase. At this stage, debates about manipulation no longer matter. The market has moved beyond debate. Silver has entered the realm of necessity. Industries that once optimized for cost now optimize for survival. Governments that once ignored stockpiles now defend them. Investors who once traded contracts now demand custody. The metal itself has not changed, only its role has. For most of modern history, silver was abundant enough to be ignored. That era is ending. Electrification is not slowing. Militarization is accelerating. Deglobalization is reshaping supply chains. These forces are not temporary. They are structural. And structural forces do not reverse because prices rise. They adapt by redefining value. This is why silver does not need hype. It does not need promotion. It does not need belief. It only needs reality to catch up. Every ounce pulled into long-term industrial use tightens the system further. Every export restriction reduces flexibility. Every inventory drawdown increases fragility. Eventually, the market reaches a point where it can no longer pretend abundance exists. That is not collapse. That is recognition. Recognition that a small, indispensable metal has been underpriced for a very long time. Recognition that paper claims cannot replace physical certainty. Recognition that availability is the ultimate form of value. And when recognition arrives, it arrives all at once. This is why silver moves shock markets when it finally moves. Because it reprices years of denial in months. In the end, the silver story of 2026 will not be remembered for a single price level. It will be remembered as the moment the illusion ended. The moment when the screen price stopped being trusted. The moment when possession mattered more than prediction. The moment when the world remembered a simple rule: markets never escape. You cannot print supply, you cannot negotiate scarcity, and you cannot replace what no longer exists. Silver does not need to be understood by everyone. It only needs to be needed by enough. After the repricing comes the consequence. This is the stage where silver's impact spreads beyond metals markets and into the real economy. Not through headlines, but through friction. Projects begin to slow, budgets are rewritten, timelines stretch. For industries built on tight margins and just-in-time supply chains, silver becomes a bottleneck. Not because it is unavailable everywhere, but because it is unavailable at scale. A factory might secure enough silver for this quarter, but the next quarter is uncertain, and uncertainty forces decisions long before shortages become visible. Some manufacturers redesign products to use less silver, others downgrade performance. Some simply absorb higher costs and pass them on. This is how inflation quietly embeds itself into technology. The irony is that silver was once considered an inflation hedge. Now it becomes an inflation driver. As input costs rise, finished goods rise with them. Energy systems, electronics, vehicles, medical devices all feel the pressure. This is when policymakers finally react. Not to silver directly, but to the effects silver is creating. Subsidies are expanded to offset higher costs. Strategic exemptions are created for priority industries. Import rules are adjusted. Export controls quietly multiply. Each intervention solves a local problem while worsening the global one. Supply chains fragment further. Price discovery becomes regional. Transparency disappears. A silver market no longer exists. There are silver markets, one price in Asia, another in Europe, another in North America, each reflecting local access, policy, and urgency. This fragmentation marks a permanent shift. Globalized commodities rely on free flow. Once that flow is politicized, efficiency dies. This is why silver's repricing does not reverse easily. Even if demand cools temporarily, trust does not recover quickly. Buyers remember shortages far longer than surpluses. Inventory strategies change permanently. Companies that once carried weeks of supply now aim for months. Governments that once ignored metals now classify them. Funds that once traded volatility now seek custody. This locks up supply even when demand stabilizes, and locked supply is indistinguishable from lost supply. At this stage, new mining projects finally appear on paper. Announcements are made, exploration budgets rise, stock prices surge, but reality lags. Mines take years to build, infrastructure takes longer, environmental approvals stretch timelines further. By the time new supply arrives, the world has already adapted to scarcity. This is how commodity cycles end, not with relief, but with normalization at a higher level. Silver does not return to cheap, it returns to essential. This is the phase where narratives flip completely. What was once considered extreme becomes conservative. What was once dismissed becomes obvious. What was once optional becomes mandatory. And the final realization settles in. Silver was never scarce because the earth ran out. It became scarce because civilization decided it could not function without it. That decision was made quietly, one technology at a time, one policy at a time, 1 year of deficit at a time. By the time anyone noticed, the equation was already irreversible. This is why the silver story does not end with price targets. It ends with behavior. How systems adapt, how priorities shift, How value is redefined, because in the end, markets are not governed by belief. They are governed by necessity, and necessity does not negotiate. 5 years after silver's revaluation, the world no longer argues about whether it was justified. The debate has shifted from price to access. What once seemed like a market anomaly is now embedded into planning models, national strategies, and industrial assumptions. Silver is no longer discussed as a trade. It is discussed as a constraint. In the years following the repricing, the most visible change is not the metal itself, but how quietly it disappears from public conversation. This is not because the issue has been resolved, but because it has been absorbed. Systems adapt not by reversing damage, but by normalizing it. Scarcity becomes routine. High prices become baseline. Volatility fades, not because supply recovered, but because demand learned to live within limits. The first permanent shift appears in industrial design. Engineers stop assuming silver abundance. Product architectures change. Circuits are redesigned to minimize usage. Performance trade-offs become acceptable where once they were not. In some cases, silver is replaced. In others, it cannot be. Where substitution fails, cost becomes structural. This creates a technological stratification. Premium systems retain high silver content for maximum efficiency. Mass market products accept lower performance. Innovation slows not because talent disappears, but because material limits define the ceiling. Progress becomes selective. Energy infrastructure reflects this shift most clearly. Solar deployment continues, but the pace becomes uneven. Regions with secured supply expand rapidly. Others lag. Governments prioritize grid-critical projects. Subsidies flow not to consumers, but to supply assurance. Energy independence narratives quietly evolve into material-independent strategies. Electric vehicles follow a similar path. Early optimism about universal adoption fades into realism. Production targets adjust. Margins compress. Manufacturers consolidate. Smaller players vanish. The survivors are those with long-term metal contracts, vertical integration, or state backing. The rest are priced out. Defense industries move first and speak last. Their demand never enters public markets. Procurement shifts to closed channels. Strategic stockpiles are expanded quietly, then classified. The concept of market price becomes irrelevant for certain buyers. What matters is guaranteed delivery under any condition. This creates a dual-use dilemma. Silver is both civilian and military critical. That duality changes how it is governed. Export approvals become political decisions. Trade disputes emerge not over tariffs, but over molecules. Diplomatic pressure replaces bidding wars. Access becomes leverage. Over time, this reshapes global alliances. Countries rich in silver production gain strategic relevance disproportionate to their economic size. Others invest heavily in recycling technologies, though returns remain limited. Urban mining becomes a policy focus, but scale never matches need. The mining sector itself undergoes a transformation. New projects do come online, but slowly. Capital is cautious after years of regulatory uncertainty. Environmental opposition intensifies as higher prices incentivize lower-grade deposits. Social license becomes harder to secure. Supply grows, but never enough to restore abundance. This gap between expectation and reality changes investor psychology permanently. Silver is no longer treated as a cyclical trade. It becomes a strategic holding. Volatility compresses as speculative leverage disappears. What remains is ownership, not exposure. Paper markets survive, but their role diminishes. Futures become hedging tools for industrial users, not vehicles for price discovery. Physical premiums remain persistent. Delivery clauses become central. Custody matters more than yield. This redefines financial infrastructure. Warehousing becomes a growth industry. Insurance products evolve to cover political risk. Audits become more frequent. Transparency increases where trust once sufficed. Retail participation declines over time, not because interest fades, but because barriers rise. Minimum order sizes increase. Availability narrows. What was once accessible becomes specialized. Silver ownership becomes intentional rather than casual. Education systems adjust indirectly. Material science gains prominence. Resource constraints become core curriculum topics. The idea that technology progresses independent of inputs is quietly abandoned. Limits return to the conversation. Politically, silver never becomes a headline issue. It does not need to. Its effects are diffused. Prices rise incrementally. Subsidies mask impact. Consumers adapt. This is how systemic change avoids resistance. Inflation statistics never fully capture the shift. Silver's influence is embedded in thousands of products, each with marginal price increases. No single spike triggers alarm. Instead, purchasing power erodes quietly. This teaches policymakers a lesson they rarely admit publicly: monetary tools cannot solve material shortages. Printing money does not create atoms. Interest rates do not refine metal. Industrial policy replaces monetary optimism. Over a decade, this alters how societies think about growth. Unlimited expansion becomes implausible. Efficiency becomes priority. Longevity replaces turnover. Repairability returns as a value. Silver's role in this transition is symbolic. It exposes a flaw long ignored. Modern civilization assumes infinite inputs in a finite system. When one critical material breaks that assumption, the illusion dissolves. This does not lead to collapse, it leads to recalibration. A slower, more constrained world emerges. One where trade-offs are explicit. One where abundance is engineered, not assumed. Looking back, historians do not mark silver's repricing as a crisis. They mark it as a signal that the era of frictionless globalization had ended, that materials mattered again, that physics reasserted itself over finance. The most important outcome is not price stability or supply growth. It is awareness. Awareness that markets cannot abstract reality forever. That leverage has limits. That substitution has boundaries. In this world, silver is no longer dramatic. It is respected. It is planned for. It is budgeted as a risk, not a commodity. And that is how its story ends, not with a spike, but with permanence. Not with panic, but with acceptance. Not with collapse, but with constraint. Because the final stage of every material revaluation is not correction. It is integration. Silver does not disappear. It settles into its true role. When historians step back far enough, silver's repricing is no longer about a metal. It becomes a case study in how civilizations respond when assumptions collide with limits. Every advanced society is built on invisible foundations. Not laws or currencies, but materials. Stone Ages, Bronze Ages, Iron Ages were not metaphors. They were descriptions of capability. What a society could build, defend, transmit, and preserve was dictated by what it could extract and process reliably. The modern age believed it had escaped this rule. Finance, digitization, and globalization created the illusion that materials were interchangeable, that shortages were temporary, that price alone could summon supply. Silver quietly disproved that belief. The repricing marked the moment when abstraction failed. For decades, economies optimized around efficiency rather than resilience. Supply chains were stretched across continents. Inventories were minimized. Redundancy was labeled waste. This worked only because material abundance was assumed to be permanent. Silver revealed how fragile that assumption was. When one small but essential input tightened, entire systems slowed. Not collapsed, slowed. And slowing is far more destabilizing than sudden failure. Collapse creates urgency and unity. Slow constraint creates friction, inequality, and reordering. Societies began sorting themselves not by ideology but by access. Those with secured material flows maintained momentum. Those without adapted downward. The difference was subtle but cumulative. Infrastructure aged differently. Technology diffused unevenly. Standards diverged. This is how civilizations fragment without borders changing. The idea of a single global technological frontier dissolved. There were now multiple frontiers, defined not by innovation alone, but by resource security. Progress became conditional. This altered political behavior in ways that were not immediately obvious. Diplomacy became transactional around inputs. Alliances formed around supply guarantees rather than values. Neutrality lost meaning when materials were strategic. In this world, moral arguments mattered less than logistical ones. History shows this pattern repeatedly. When Rome struggled to secure grain, its politics shifted. When Britain lost access to cheap resources, its empire contracted. When oil reshaped the 20th century, power reorganized around producers and choke points. Silver fits this pattern precisely, but with a modern twist. It is not a single-use fuel. It is embedded everywhere, which means its influence is diffuse, persistent, and hard to reverse. Over time, this reshaped cultural attitudes toward consumption. Disposable technology felt irresponsible. Repair culture returned quietly. Longevity gained status. Waste became visible again. This was not driven by environmental awakening alone, but by cost. When replacement became expensive and uncertain, preservation regained value. The future leaned less on novelty and more on stewardship. Education followed this shift. Engineering emphasized efficiency per unit of material. Economics reintroduced physical constraints. The separation between real and financial economies narrowed. Students were taught that markets are representations, not creators of reality. This produced a generational divide. Those who grew up before scarcity still thought in terms of price. Those who grew up after thought in terms of availability. This difference shaped risk tolerance, investment behavior, and politics. Trust in purely paper claims never fully recovered, not because systems collapsed, but because memory persisted. Once people experienced a world where money could buy anything except what they needed, priorities reordered. This did not end capitalism, it matured it. Speculation did not disappear, it moved elsewhere, toward technologies that promised substitution, toward materials science, toward efficiency gains. Capital chased solutions rather than leverage. Some succeeded, many did not. The silver constraint did not halt innovation, it redirected it. Innovation became harder, slower, more expensive, and more meaningful. Breakthroughs mattered again because margins were thin. From a distance, the decade after silver's repricing looked quieter. Fewer booms, fewer crashes, more plateaus. But beneath that calm was a deeper transformation. The belief that growth could be decoupled from material reality faded. Not dramatically, gradually. The way beliefs always change when experience contradicts them long enough. Silver did not end an era by itself. It revealed that an era had already ended. The era of assuming someone else would supply what you lacked. The era of mistaking liquidity for abundance. The era of believing price could replace physics. In its place emerged a more constrained, more honest world. Not poorer, but less naive. Not slower, but more deliberate. And this is how silver's story ultimately closes. Not as a crisis, not as a victory, but as a correction. A reminder that civilization advances not by escaping limits, but by understanding them. That markets are powerful tools, but poor masters. That materials matter. That reality always settles the balance. Silver was simply the messenger. In the final analysis, silver's story is not only about metal, supply, or markets. It is about human behavior. Scarcity reveals character, incentives, and priorities more clearly than abundance ever could. The first truth is that people respond to necessity differently than they respond to opportunity. When resources are unlimited, ambition dominates. When resources are constrained, strategy dominates. Patience, foresight, and access become more valuable than capital alone. Those who can plan for scarcity prosper, even if they never predict the exact outcome. Those who assume the past will repeat often find themselves powerless. Early winners were often invisible. Industrial conglomerates with long-term contracts quietly expanded margins. Governments that had prepared stockpiles never had to announce them. Private vaults and custodians of physical silver quietly strengthened positions. They did not make headlines. They simply acted, and their advantage compounded over time. Speculators who relied on leverage and paper exposure fared worse. When premiums for physical silver surged and delivery became restricted, paper positions became meaningless. Futures contracts, ETFs, and derivatives no longer guaranteed access to the metal they represented. The psychological effect was profound. Many who had assumed confidence would last indefinitely faced sudden dislocation. The lesson was brutal, but clear confidence in abstraction is fragile, possession of reality is resilient. Consumers, meanwhile, learned a different set of behaviors. They shifted from passive participation to active planning. Industries that could not afford interruptions stockpiled metals, diversified suppliers, and prioritized critical processes. Societies adjusted consumption patterns. Luxury or optional applications of silver were reduced, recycled, or replaced. Technology became less disposable, less abundant, more deliberate. Convenience was traded for certainty. Power itself began to migrate. Countries, regions, and corporations that could secure access to physical silver gained strategic advantage. Trade relationships, alliances, and supply agreements became as much about control of materials as about economics or politics. Sovereign reserves were quietly strengthened, and industrial strategy overtook purely financial strategy in importance. Monetary influence diminished relative to control over production and delivery. In a world of scarcity, control equals power. Psychologically, this shift was subtle but permanent. Confidence in unlimited supply eroded. Patience and foresight became more valuable than aggressive speculation. People began to understand the difference between ownership and claims, between control and paper promises. Trust shifted from abstract institutions to tangible assets. That shift changed behavior across entire generations, embedding caution and strategic thinking into decision-making at every level. The losers in this long arc were predictable but widespread. Entities that relied solely on paper exposure or assumed global liquidity was permanent suffered losses. Those who assumed scarcity would be temporary underestimated the duration and permanence of supply constraints. Political and economic actors that ignored industrial necessity were forced to adapt reactively rather than proactively, often at great cost. Societies that depended on imports without alternative strategies faced delayed technology, higher costs, and slower growth. The winners, by contrast, were equally predictable but quieter. Those who understood supply fundamentals, who built physical reserves, and who prioritized security over speculative gain prospered. Industries that restructured for long-term resilience outpaced competitors. Governments that integrated resource strategy into policy maintained technological and strategic advantage. Even individuals who held tangible assets responsibly gained security and influence. Human behavior under scarcity is not uniform. Some hoard, some strategize, some innovate, some capitulate. The silver market exposed these differences in stark relief. It taught a lesson repeated throughout history: scarcity is not just an economic phenomenon, it is a social and psychological one. It rewards planning, foresight, and flexibility. It punishes hubris, assumption, and impatience. This is why silver's story is not only about a metal, but about civilization itself. It is about how societies allocate resources, how industries adapt, and how humans respond to limits. It is about the intersection of psychology, economics, and geopolitics. And it is about the long-term consequences of neglecting essential realities. In the decade following silver's repricing, winners and losers were not defined by momentary advantage or market timing. They were defined by understanding scarcity, internalizing its lessons, and building systems capable of enduring it. Those who failed to do so were relegated to dependence. Those who succeeded became architects of a new order in which knowledge of materials, foresight, and access determined influence and survival. By the end of this arc, the lesson is undeniable: markets may fluctuate, currencies may rise and fall, policies may change, but reality, constrained, finite, and physical, always asserts itself. Silver, small and overlooked for centuries, became a lens through which the broader truth was revealed: human systems function only within the limits imposed by nature, and those who recognize and respect those limits thrive, while those who ignore them pay the price.